Now time to go to Adam for all the business news.
Thanks, Eileen. Well, just moments ago, the European Central Bank once again announced a cut in its interest rates. It brings its deposit rate to 2.75%. That's the lowest it's been since early 2023. The bank has been steadily cutting rates since the middle of last year, following an easing in the rate of inflation in the region. The ECB is also keeping one eye on economic activity in the euro area, which has been subdued in recent months. Some fear that the bloc could slip into a recession. Well, for more on this, we're joined in studio now by Daragh Cassidy, Head of Communications at comparison site bonkers.ie. Daragh, who stands to gain from today's rate cut?
There's a few gainers. I think tracker customers in particular will be the happiest with today's news. Now, mind you, there aren't a huge amount of those customers left, but they're going to see their mortgage rates and their repayments fall again. Since last June, when the ECB began cutting rates, the average tracker customer now will have been saving perhaps €150 or more a month on their repayments. So that's good for them. I think variable rates from the main lenders will start to fall. So that's good news. And also the so-called mortgage prisoners. So these are the people whose loans were sold to vulture funds and who in some cases are paying really, really high variable rates of maybe 6 or 7% and who can't switch because they're kind of stuck. They'll see their rates begin to fall. So I think this will be really beneficial for them.
So they're standing to gain. Who might lose out from today's decision?
There's a few losers. I think we forget that there's winners and losers to falling interest rates. The main losers are savers. So already since the start of the year, AIB, Bank of Ireland, Bunk, N26, plenty of savings providers and banks have reduced their savings and deposit rates. And I think that is going to continue over the next few months. So I'd be saying to anybody who's watching and listening, if you have savings, do something with them before rates start to fall even further. The euro might remain under pressure against the dollar because the Fed recently just kept rates the same. The ECB is on a different trajectory. So if you're off on holiday to the States this year, you're not going to get a good exchange rate. And I think for prospective first-time buyers or people who are hoping to get their foot on the property ladder, it's a bit of a double-edged sword because, yes, mortgage rates for them will fall, but it's probably just going to reignite the property market and overheat the property markets at a time when we really, really don't need it.
A very complicated picture ahead for some. Daragh Cassidy from Bonkers, thank you for that.